Hello and welcome to Moneylife News and Views. I'm Debashis Basu. The Securities and Exchange Board of India has unveiled a consultation paper to revise the regulatory framework governing investment advisors and research analysts. Among the suggested ideas are relaxation of entry criteria such as minimum qualifications, certifications, and net worth requirements. They're also suggesting allowing part-time investment advisors and research analysts, and of course, independent compliance officers, and relaxing the definition of principal officers. All this may sound a lot of definitional and arcane, vague stuff, but the whole idea is to make the population of RAs and IAs grow so that they are commensurate with the large number of people who are investing in the stock market. But will these and other changes proposed by the new framework actually achieve these Sebi objectives? Over the last few years, as we know, the Indian stock market has attracted crores of new investors, literally 16.4 crore demat accounts now. But as the consultation paper says, the number of IAs, that is investment advisors, and research analysts is not commensurate with the large investor base. This is leading to the proliferation of unregistered entities acting as advisors. Now, Sebi wants the services of these people to be available to more investors with a much larger number of, for which a much larger number of advisors are required. Now, will the proposed changes, as I said, lead to this laudable objective? In an ideal world, investors' primary source of information should have been the traditional business media, and better still, Sebi registered advisors and research analysts. For the sake of easy to understand, I'm just using the term analysts. The difference between investment advisors and research analysts is not something that we would like to get into because it's just too vague and unrelated to a general comprehension of the issue. Now, as I said, in an ideal world, people should be going to advisors, but like moths to the fire, millions of investors are attracted to social media for investing wisdom. This is the domain of self-styled investment gurus, trainers, influencers, who are all functioning illegally if Sebi rules were to be strictly applied. Collectively, they are a formidable force. While Sebi has attempted to crack down on many of them, it takes a lot of hard work, painstaking work to investigate facts, give them time to reply, make out a case, issue a show cause notice, and then pass a reasoned order. There are two major issues with using legal action to control illegal advisory. One, the penalty is usually too meager to act as a deterrent. An advisor, for instance, I'm giving a live example of an advisor who did not perform the Know Your Customer process as required under the Prevention of Money Laundering Act, did not do risk profiling, had no records to show for suitability of advice and investment rationale, and did not have an audit done. These are the most important parts of the law. Among the many violations his firm was guilty of, got away with a fine of just 6 lakhs. The second problem with Sebi's battle against illegal advisors is that many of them have become smarter. They couch their services as training courses after advertising very high returns that they themselves have notched up. It turns out these trainers are hopeless traders or investors, as the leaked income tax returns show. They can be accused of misrepresentation and cheating, but it is up to investors to file such cases of cheating. Sebi can act only when they impart buy-sell advice of Sebi-regulated products such as stocks, mutual funds, and bonds. Sebi cannot act for false claims of their investing or training prowess. The net result, the tribe of influencers would keep growing until, of course, there's a bear market when influencers would stand discredited and then investors would leave the market in droves, very, very disappointed with what they had got into. Now, can the new relaxed norms proposed by the consultation paper mean that investors can be weaned away from the overwhelming tide of influencers, and can the law encourage them to approach Sebi-registered advisors, as Sebi hopes? The suggested changes make it easier to register as an advisor or an analyst, but the entire gamut of onerous record keeping, disclosure, audit requirements have been left untouched. Sebi has also added more paperwork now that regulating advisors has been delegated to a third party, the Bombay Stock Exchange owned BSE Administration and Supervision Limited. Now, the current rules require advisors to perform objective risk profiling of clients, which should include a host of details, financial details such as goals, preferences, borrowings, current investments, savings, expenses, personal taxation, and so on. Advisors also have to record the suitability of products recommended and also the rationale for every piece of advice provided. They must also have a documented process of selecting investments based on the client's objectives and financial situation. Advisors cannot accept fees through credit cards and have to sign lengthy and intricate investor agreements with 26 clauses, which can be overwhelming for clients and resource intensive for IAs, that is, advisors. They also have to maintain records written and signed by them, telephone recordings, emails, SMS messages, or any other legally verifiable record for 5 years. Just 3 months ago, Sebi announced that every 6 months, advisors will have to declare to BSE ASL dozens of minute operational details, over 8 pages, such as shareholding pattern, beneficial owners with more than 10% capital, number of clients, advertising details, distributor commission, details of social media handles, details of bank accounts for receiving advisory fees, details of contact person, principal officer, advisors providing advice, details of managing director and other directors as well. Now, while Sebi has a justification for all these disclosure, compliance, and record keeping, such norms will keep the advisor population stunted. I'm not suggesting that these norms should be relaxed. The fact is that investment advice is a small business if done in the right way. Like insurance, there is no natural pull. Investors are not seeking it. This is why there are hardly few hundred investment advisors, even as the total demat accounts have exploded to over 16 crores. The issue at hand is not just strict entry criteria being relaxed. The ratio between the effort of following Sebi rules and the reward that the business brings is simply not attractive enough. A silver lining in all this is Sebi's effort to redefine the research analyst's work. Currently, it's a confused piece of regulation designed principally to cover banks and investment banks and brokerages, while imposing very tough and meaningless requirements for independent analysts. Although the paper prescribes much more documentation for analysts, the newer ones, it also clarifies their roles, allowing them to offer model portfolios, which under the current rules is considered investment advice. Given that almost all investment advice in real life is stock related, there will be a sharp rise in RA registration. Platforms that were illegally offering model portfolios, such as Small Case or Cherry of Kotak and so on, will all become legit. Meanwhile, investment advisory will remain a struggling profession governed by an elaborate but irrelevant pile of rules. This will be an unintended but not a bad outcome. As I said, investors look for only stock-related advice, which RAs may be allowed to offer, assuming the recommendations are accepted. Holistic financial planning and advice, the job that the investment advisors are supposed to do, that attracts too little interest from customers, while making too much of a demand on the providers, that is, advisors of such advice. A few years later, Sebi may have to do another revamp of IA regulations. Their tribe is not likely to grow. If you like this, please do share and please do subscribe to our channel if you haven't done already. Thanks for watching.